My name is Jake, welcome to the channel, and today's video we're going to take a look at an article titled How to Retire in 2025 on Dividends. This is here on Seeking Alpha from Colorado Wealth Management Fund. If you've been following my channel, I try to review an article about once a month or so, and I'm going to take a completely different approach to this video. In today's video, I'm going to just basically summarize the article, highlight a few points that I think are interesting, and then mostly share my thoughts and opinions, go through some of the comments. But yeah, I'd be interested to hear what your thoughts are, if you like which format better, where I read the article word for word, or more focus on summarizing it and sharing my thoughts and opinion. So the investing approach that I really talk about on my channel is the simple path to wealth with dividend investing, which was inspired by J.L. Collins, where you're focused on dividend ETFs as your core portfolio, and you're going to live off the income from those dividend ETFs. And really the emphasis here is keeping it simple versus owning 20, 30, 40, 50 individual stocks and having to manage those on a regular basis. And so that's why I like to adopt what J.L. Collins talks about, the simple path to wealth. And I threw my own little dividend spin on it and applied it, to fit me and as a dividend investor. And what I've found over the years is that the simple path here is so much easier than the more complex path. And I think most people would be probably better off if they would focus on the simple approach versus trying to over-engineer it and maybe copy somebody online or somebody that they've seen in a video or in a blog talk about how they have like 20 or 30, 40 different stocks. So a lot of you I know are new dividend investors or new investors, or maybe you're not. But I will say that before you find the simple path to wealth with dividend investing, I'm sure dividend investing, which was much more complicated than it is after finding the simple path to wealth with dividend investing. And that could maybe look a little like this. My gosh. Oh man. All right, cool. So here, before we dive into the article, really quick, I want to tell you about today's sponsor, Snowball Analytics. I really enjoy using Snowball Analytics. I get a lot of value out of this tool, and that's why I love partnering with them, and I want to share with you a little bit about them in today's video. So once you set up an account with Snowball Analytics, you can import your brokerage into them directly, so you don't have to manually add all of the individual holdings that you have in your portfolio. You can simply upload your brokerage directly by connecting it. So you can do that whether you have a Fidelity brokerage, a Robinhood, a Schwab, M1 Finance, Interactive Brokers. So if you're outside of the United States, you're able to connect your brokerage into Snowball Analytics. Once you've connected your brokerage into Snowball Analytics, or you've uploaded all of your holdings in there, you'll be able to see all of your holdings and the different metrics that are important to you as a dividend investor. All, just really an overall snapshot of your portfolio and all the important metrics that you would want to see. And then if you wanted to dive into the individual metrics or your portfolio-wide metrics, this is one of the things that I really like about it, is you have your weighted portfolio average calculated in Snowball Analytics. So you can see the individual yield on cost for each holding, as well as your portfolio weighted average yield on cost. And my personal favorite feature is the dividend calendar. I pull this up here on my desktop, or when I'm on the go on my phone, you can pull it up and you can see what you're going to be getting paid for that month and project it out over the course of the year. And you can see who's paying what and when they're paying the dividend. What I really like about Snowball Analytics is their straightforward pricing. You're getting multiple tools and features and functionality with one single price, with one platform. And I really like that. They have annual and monthly subscriptions. So if you just wanted to try it out, you could do that. You can sign up for free and get a lot of the functionality for free. But if you want to unlock everything that Snowball Analytics has to offer, you can start with the starter pack, the investor pack. And until September 24th, they are running an autumn sale where you're going to get 30% off of your subscription by using the link in the description below. If you're watching this video after September 24th, you'll still be able to use my link and get 20% off. But yeah, thank you so much, Snowball Analytics, for sponsoring this video. And now let's get back to the article. So how to retire in 2025 on dividends. Let's take a look and see what they say. So they start off by saying that you'll need more than a dream and a lottery ticket if you want to retire comfortably. A solid retirement plan comes down to a balance between generating enough income and avoiding unnecessary risk. Most investors lean too far in one direction, chasing high yields while ignoring that they need growth to offset inflation. So this article doesn't really talk about dividend growth. It just really talks more about the growth in the share price. But equally as important is the dividend growth. How quickly is the income going to be growing year over year? Are you still going to be able to keep up with the pace of inflation? We've all experienced that here since about 2020, where inflation is up on a cumulative basis almost 30%. And when I say that out loud, it just hurts, right? A 30% cumulative increase over the last 4 or 5 years in inflation is just incredible. So you don't want to just entirely ignore the dividend growth piece when you're thinking about retiring off of your dividend portfolio. So the article continues here talking about invest defensively. So one of the biggest mistakes retirees make is forgetting that they no longer have 30 years to recover from a market crash. A portfolio with high volatility might work when you're 35 and still working, but it's not going to cut it when you're on a strict plan. The market often looks like it's going to go up forever, and it's easily to fall into a false sense of security. But ask anyone who retired in 2008 how that turned out. Risk management isn't a buzzword, it's survival. I started investing in 2007 and, towards the end of 2007. And every month, every week, it almost felt every day, I put money in my portfolio, I would see the value go down, and it did that for almost 2 years, right? And so it was a really, really difficult time. And, markets don't always need 30 years to recover. I think that's a little bit over conservative, over defensive. It just all comes down to having a plan for the inevitable market corrections and crashes that we're going to see here in the future. So building your portfolio. So let's take a look at what they're suggesting here. So building your portfolio, retirees are often looking for investments that offer strong dividends. You should be able to rest easy knowing your portfolio isn't a roller coaster. The last thing a retiree needs is to lose sleep at night wondering if their portfolio just blew up. I'll be focusing on some dividend stocks that have stood the test of time. Now, what he says here is so true. For those of you that know my story, I've been living off my dividend portfolio for about 2.5 years now, and I am happy to sacrifice growth potential for stability, right? I don't want to have the boom or bust. I don't want to be forced to, unfortunately, go back to work and work a 9 to 5 because because the market's in a recession, or, the economy is not doing so well, or inflation is too high. For whatever reason, I'm happy to sacrifice a little bit of growth potential for more stability and security in my portfolio. But hey, that's just me. That's my personal opinion. Everyone's got to do what's right for them. But that is a very, very true statement. And you ask anyone who's maybe retired or nearing retirement, their goals change. They're no longer in their 20s or 30s where they are willing to take on risk. And, it's just the game entirely changes. Okay, so let's take a look at the portfolio that they are suggesting that you should consider, or how you could retire on dividends here in 2025. So they're suggesting companies like Altria Group, Philip Morris, Procter & Gamble, 3M, that's a weird one, Johnson & Johnson, Coca-Cola, PepsiCo, Lowe's and Home Depot. So there's a lot of monopolies and duopolies here. So, the duopolies in each of these industries, I guess. You got Realty Income, you got Triple Net, you got Apple, and you got Meta. And then he's suggesting ExxonMobil, Visa, and MasterCard. And then Walmart and McDonald's. He's also suggesting that you should look at preferred shares, like NLY or AGNC. Some of these are, I think they're like mortgage REITs, if I'm not mistaken. And then you got baby bonds, and then you got different bonds like short-term treasuries. So he's suggesting a portfolio of, large cap stocks. I'm assuming, like large companies in their industry, like, Philip Morris, Altria Group, Home Depot, Lowe's, Coca-Cola, Pepsi, where there's like a duopoly, I guess. And he's suggesting to invest into a portfolio like that you can then live off of. And the example that he gives in this article is someone that has a portfolio of about $800,000. And, the allocation that he has in each one of these. So the percentage of the income. So here on the left side, you got the income, the percentage of the income from each individual holding, and then the percentage of the allocation, right? Because they're not the same. Altria Group is weighted at 2.5%, but has a higher starting yield. So obviously you're going to get a higher proportion of your income. That was my phone that dropped on the chair there. I'm not going to edit that out because I think that's funny. Because I'm in the flow here. I'm in the flow. I'm not going to edit this out. So you got Altria Group has a higher percentage of the weighted, of the income that you're going to be getting, though it has, a 2.5% percentage. So I think a lot of you understand that. A lot of you will look at that and probably be confused. And so I just wanted to dumb it down a little bit and make sure that everybody understands and on the same page. So he's saying here that, he has a lot in, individual stocks. It does look like he has some ETFs in here, like VIG and VYM. So about 12%. And then he has some bonds in here. So he doesn't, I wish he would have talked about the ETFs in the article, but he has it here in the spreadsheet that he shows. And so he has a small percentage, I guess, into ETFs as well. So I like that. And then the total portfolio. So the assumptions that he's assuming here in the example that he's giving with somebody that has $800,000 and they're retired, living off of Social Security, the total portfolio income would be $31,000. And we would assume that the individual is bringing in $22,000 per year in Social Security. So this comes out to be about $53,500 for one person. So, whether you're married, maybe the other person has, Social Security as well. So you could assume an extra $20,000 or $22,000. So that's what, like $75,000-ish, right? $75,000, that's about on the median average household income here in the United States. So that's not crazy. Now, obviously, if you're in California or New York, high cost of living area, $75,000 for a household is not going to be a lot. It's definitely possible if you have your house is paid off, but it's manageable, right? Like you could make this work. I don't see what the portfolio weighted yield is. Can we see that here? I don't think we can I don't think he has it calculated by the portfolio weighted average yield, but I think it's like right on like 3%, 2 or 3%, something like that. So that's where, you kind of want to scratch your head and say, okay, you're investing into a handful of stocks. You're getting, stocks, ETFs, and a few bonds. You're getting around a 3% dividend yield, which I would say is very conservative, right? There's not a lot of speculation in there. You have a few sin stocks. The sin stocks represent 5% of the overall portfolio. There's 2 of them. Absolutely fine in my opinion. So retiring on a strategy like that, I don't see a lot of red flags in terms of like risks, right? And that was part of the thesis of his article here, was that you don't want to take on a lot of risk when you're looking to retire off of your dividend portfolio, right? So in the conclusion here, he writes that, are these the best companies? No. Are they the most popular? Not quite. Maybe some of them like Meta, for example, but many of the most popular companies don't pay a dividend. Could we have included them? Sure. Would that work well for an article focused on dividend stocks? Well, not really. So that's, I guess, kind of the challenge here. When you look at the S&P 500, the S&P 500 has a forward yield of like just over 1%, right? Dividend stocks over the last 3 years, I was, looking at this just recently for my own portfolio, dividend stocks have lagged the market over the last 3 years, right? And it can be a little bit soul crushing, I guess, to see the dividend stocks and, dividend investors underperform over the last 3 years. Like even DJRO is underperformed, and it's more of a growth-centric dividend growth ETF. So, you know, dividend stocks are not always the sexiest stocks, but when you're in retirement and you're looking to live off the income from your portfolio, you don't always have to have the sexiest, flashiest, fastest thing, right? And I think that's part of the point. Now, when you're younger and you're looking to accumulate your wealth, well, yeah, you don't want to invest like your grandpa when you're 20 years old if you have like a 20 or a 30-year time horizon, right? It just comes back to understanding how do you invest based off of your investment time horizon, and how do you make the numbers work for you based off of your own personal goals and situation. All right, now let's take a look at a few comments. So the first comment here is, why not just buy funds like GPIX, GPIQ, QQQI, and SPYI? These are all covered call ETFs with an average dividend yield or distribution yield of 8, 9, 10, 11, 12%. So very, very high distribution yields. And compound your dividends. Why bother with 2 to 3% yields? Now, this is a very, very valid question. And I think most people on YouTube, most people on X and on social media, we are generally younger, maybe millennials, Gen X, Gen Z. They don't understand, why would you invest into a 2 to 3% yield when you can get a 12%? Why stop there? Why would you not, everyone just buy these yield max ETFs and get a 76% yield, right? Like, duh, obviously. Well, it's a little bit more nuanced than that, and it's important that you understand. So I really like the exchange here, and I wanted to review it here. So the author of the article wrote, I'm not a big fan of those expense ratios. You know, SPYI has an expense ratio of 0.68%. Are they going to guarantee me, a rate of return? Because that's a big amount to be paying if you've got a heavy, account balance on a $2 million portfolio. That's $13,600 per year. And I thought the response was really interesting. So, right. And $240,000 a year in dividends. So are you worried about $13,600 in fees when you get $240,000 in dividends? There is a good chance you still have all your capital or more. And if you buy QQQI, which tech is very strong right now, you'll make even more. How much dividends is your 2 million getting you at 2%? 40,000? So because of the fees, you're against getting an extra 200,000 in dividends. Of course, QQQI and SPYI could go down, but so could Coca-Cola, Altria Group, or Johnson & Johnson. I think that this is such an incredible comment, and it's a really valid point. Why would you buy something? Why? And, I think this is why these covered call ETFs are so popular. And these covered call ETFs are really popular. We're in a bull market. The Nasdaq's, at an all-time high. Today's, I'm recording this here late Friday, and yeah, the market's at all-time highs. So obviously you're going to get questions like this, and they're very valid, especially given the economy right now and how the market's, how the stock market, the economy and the stock market are different, how the stock market is doing. So how does he respond here? Dividends when the manager sends you part of your investment back. So, return of capital, all that good stuff. I guess the question here is, how do you, I think both of these sides, right? The author and this comment, both things can be true at the same time, right? And that's why it's so important to diversify. And me personally, I think cover call ETFs are great. I personally prefer cover call ETFs over sin stocks. In fact, I sold my Altria Group and my Philip Morris, even though it still went up after I sold it. It's done very, very well this year. I don't care. I transitioned out of that and into, JEPQ, for example, and I've done fine, right? And you just got to do what works for you. I find that there's less risk in a cover call ETF like JEPQ than single stocks, but that's my personal opinion. But I will say not all cover call ETFs are created equal. Some of these cover call ETFs are not good, and I wouldn't touch them with a 10-foot pole, but you just got to do your own research. I think, the NEOS ETFs, they're fine. I made a video in the past. A lot of people comment on that. I'm not the biggest fan of Neos. The company the company's not been around long enough. It's just maybe in a couple of years. I think their performance, they've done very, very well. I personally would rather go with, more established company like a JP Morgan or a Goldman Sachs. But that's just my opinion. But yeah, I think it's a really, really interesting. Yeah. Why go for 2 or 3% when you can get 77%? Riddle me that. Another question here is 3M slashed its dividend by 50%, ending a 67-year streak of uninterrupted payouts when it cut in May 2024. You wrote am I misunderstanding the meaning? So 3M is facing challenges, however, it's still a strong contender with 64 years of dividend increases. Okay, yeah. So yeah, they absolutely did cut their dividend. Well, thank you. And then the author responded to the comment, well, thank you for calling that out. I will need to notify some data services that their years of growth figure is inaccurate. That's one of the few metrics I usually just assume will be accurate. So I'm sorry, but I got to kind of call a flop when I see one. This, when you're writing financial commentary for a living, right, which this individual I would assume is, you can't make a mistake like that, right? 3M, you can't suggest 3M as one of your how to retire in 2025 on dividends if you don't know that they cut their dividend, right? Like, why are you even suggesting this stock? Are you suggesting this because you saw it on a chart or a list and the list happened to be wrong, therefore you're not going to recommend it anymore? This is the illusion that people have that they're going to pick stocks and they're going to do it effectively. This is what happens when you don't follow up on your stocks. And if you're not going to follow up on them, in my opinion, you shouldn't be investing in them. In most cases, not in every case, but in a lot of cases. And this 3M was all over the news. I think this is kind of embarrassing. I'm going to use the word embarrassing that this author included 3M and didn't know that they cut the dividend. It's very, very embarrassing. And obviously, I'm going to throw that out there. I make mistakes all the time, guys. I'm not like, on some pedestal. I do make mistakes a lot of times, but it's also embarrassing when I make mistakes. So I'm calling it as I see it. Another comment here, for the average Joe, get yourself a high income ETF. It's probably easier unless you really like to track everything yourself. QQQI, GPIQ. ETFs are a great way if you don't want to do this yourself. And if you over rely on the data of some servicing source or whatever, or some website, yeah, probably not the right approach. Another comment here, just buy SCHD. Yeah, buy SCHD, but also buy something else. SCHD alone is not great. And you're seeing that over the last 3 years. SCHD has dramatically underperformed the market since 2023. It's kind of sad because it's my largest holding, but it's the truth. You got to add another ETF with SCHD. I like DJRO. Combining it with SCHD is great. And you could also look at, cover call ETF like JEPQ or something like that, where you're going to get a little bit more growth, more exposure to the technology sector, because SHD does not have a lot of exposure to the tech sector. And then the last comment here, why not focus on the big picture, total returns? In the defense of the author, he did touch on this a little bit, at the beginning of the article where it's talking about, security and safety as a retiree. You're willing to sacrifice the total return potential for lower returns, right? For more stability in your income. And so total returns, I don't think are, why do, so let me ask you this, right? Why do retirees hold a large percentage of their portfolio into bonds? Don't they care about total returns? Obviously, something is different when you're retired. And most of the people writing this total returns are in their 20s or 30s, and they're right for them. They should be focused on total returns. But somebody who's in their 60s or 70s or just looking to retire, they don't have to just focus on total returns, because there's more in life than living the roller coaster, as he talked about in this article. You don't want that roller coaster. And I will say, I've been living off my dividend portfolio for 2.5 years. I get it. 10 years ago, I would have been naive and wrote a comment like this as well. But now, having seen the light on the other side and it's glorious, by the way, not having to work a 9 to 5 anymore. Monday morning's great and Sunday night's great as well. But there's more to it than just total returns. And anyone that's telling you otherwise when addressing a retiree is being irresponsible and naive. So that's the article. Overall, I think he did an okay job explaining what he was trying to do. In terms of the strategy, I don't fully agree with him. I think that, 99% of financial commentary, whether on YouTube, in articles, blogs, etc., is around individual stocks. And they're selling you the illusion that you can do it better. As someone who makes financial content online for the last 6 years, it would be so much easier if I just talked about individual stocks. My videos here on YouTube will get 3 times the views, and the money that I would make would probably 3x. But I don't. I don't talk about individual stocks. I talk mostly about dividend ETFs and, cringy memes. That's what I do. But I will say, for a very small percentage of people out there, investing only into individual stocks is probably the right approach for them, or at least they think it is. But for 90%, I'm going to say 90, I'm throwing lots of percentages out here, but I'm saying 90% of regular individual investors like you and me, this is the wrong approach, in my opinion. What we read in this article, what was described on how to retire in 2025 on dividends, for 90%, this is very scientific. I'm just pointing my finger and seeing where's the wind's blowing. For 90% of you out there, I would go off on a limb and say this is the wrong approach. And it's the wrong approach because you're not Warren Buffett. Stop thinking that you're Warren Buffett and think you're going to pick the right stocks and pick them only when they go up. You're probably going to have a lot more 3Ms than you realize. That's just, in my opinion, the reality of it. And speaking of 3M, if an analyst whose primary job is to write articles and give investment advice or recommendations misses the dividend cut of a dividend king, this was all over the news. This was the news in 2024, right, for dividend stocks. They're promoting stocks like 3M. This should be your sign that if you're just a normal person, this ain't for you. This approach is not for you. And I'm talking about picking 20, 30 individual stocks and thinking that you're going to manage it. And I'll be honest, I used to think that way. I was a complete noob. I used to think that I could pick 40, 50, 60 stocks. I was going to build my own index. I thought I was being cute, but it was stupid. I was stupid. I made a mistake. And I've tried to course correct. And that's why I talk about the simple path to wealth with dividend investing, which was inspired by Jill Collins, where I focus on a small amount of high quality dividend ETFs. And while I was working, dollar cost average into them. And you do that until your portfolio is providing enough income where you can live off of it. And you can even add a small percentage into a high income ETF, like a covered call ETF, like JEPI or JEPQ or GPIQ, whatever, for example. I personally like focusing on SHD and DJRO. And once you're ready to live off your portfolio, then add a small amount of like JEPQ as an example, or another cover call ETF that you're comfortable with, or add, a satellite position, for example, a high dividend stock, maybe like an Altria Group or, a Philip Morris or something where you can boost your overall dividend yield. So you could do it like me, how I talk about in the Simple Path to Wealth, SHD, DJRO, and then, you have a covered call ETF like JEPQ, or you could also look at doing like the core and satellite, where you have a core portfolio of low-fee, broad-based dividend ETFs, and a small amount of satellite positions with individual stocks or ETFs if you want. At the end of the day, it all comes down to making it work for you. So if you're looking to retire in 2025 on dividends, find what works for you. Don't read an article like this and just automatically copy it because, you think this person knows better than you. Focus on keeping it simple and stick with the basics and ignore what the market is doing. If you're 20 years old, dollar cost into your portfolio, automate everything that you can and go live your life. Go on vacation, go work your butt off, side hustle if you want to, get married, have kids, have a family, go on vacation, live your dream, whatever that may be. Have cats and dogs. I don't know, be a cat lady or be a cat person. I don't know, dog. Do whatever makes you happy. If, investing into dividend stocks, 20 or 30 of them and, managing your portfolio every day is your thing, man, I give you a huge high five. I think that's awesome. But the reality is the majority of people are not like that, right? Go get yourself a nice video game. Go get some Doritos and some Oreos and go nerd out and have a game, a LAN party on the weekend. Go hiking, go canoeing, go live your life and do what brings you joy, and stop focusing on making this more complicated than it needs to be. Keep it simple. You can learn more about my approach, the simple path to wealth with dividend investing, by watching the video that pops up at the end of this video. But yeah, I'd love to hear your thoughts. If you haven't already, go check out Snowball Analytics, and thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.